You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, good morning, Jim. Good to be with you.
Well, after a record climb on the Shanghai market, a record drop, how are things going now?
Yeah, that was spectacular to watch. The speculative fury with new investors, traders, speculators coming into the market. They were opening up millions of accounts in a week or 2 weeks or whatever. And the SSEC, the Shanghai Index, just soared right straight up. And we were using the pattern of that speculative market as it blew out in 2007 as a model. And one of our tools is the upside exhaustion readings. And there was 3 huge clusters on the way to doing the top in 2007. So we had cluster 2 earlier in the year, and then in early June, the 3rd cluster was coming in of these upside exhaustion readings, and we just got 1, but that was enough. And then I think the high was June the 12th, and then it gave up very quickly, about 30%. And it's interesting to watch the utterances from the central bankers and policymakers in China that prior to the top, they were trying to talk it down, cool it a bit, and then bang, you get the break, and then you're immediately out there with lowering margin requirements, halt the trading on some 1,600 stocks, and everything to stop it from going down. So, anyways, we take that as technically, with the signals that we got on it, that would be a top. Then the hit suggests that it was the top. So it came down to, we had a target of the 200-day exponential moving average, and it actually did fall to 200-day ordinary moving average. And anyways, on that, it would bounce up a certain percentage gain to around the end of this month. This would be using like the collapse in the Nikkei in 1990, or the collapse of the NASDAQ in 2000, even gold in 1980. So you get this kind of a pattern. So rebound and then rolling over and dying, I guess, would be the feature on that one. And then, of course, with the pressures off of Shanghai and Hong Kong, commodities sort of stabilized a little briefly, and now here, this is in today. Some of these breaks in gold and silver are really quite something. But at any rate, we get on to that one later in the year. So the tendency in history is that you can have the outlying markets from the U.S., such now as China and Hong Kong, blow out in May or June, and we worked on that one, get hit, and then churn around, and then whatever speculative areas within senior markets, say in London or in New York, tendency to make a high there. But we're staying with the idea that on the senior indexes in New York, they would, after a surge into May, June, churning around during the summer, and then working towards new highs and towards September. And within this, in the New York market, you have the biotechs, which have been absolutely outstanding. The symbol IBB soared up earlier in the year, then did a nice correction, and then we've been looking for new highs on the IBB, mainly because of a seasonal move from early July into September. That one's to do with various conventions and shows and SEMA and all that sort of stuff. So, hey, it's working rather well. This has pulled up the S&P and the things. So we're looking at, this is, I think, the summer that ends the great bubble that arose out of the ashes of the crash of 2009, and China is saying so, then this latest rally in New York to new highs is also part of the thing. Now, underneath this, we've got our friends in the, we've been calling them friends of the bull market, for lack of a better term. And they have also registered alerts like this is, you get the outstanding margin on the NYSE went up and spiked up into April, and the May number was down, and so was the June. So, sorry, that was the peak into May, and then the June number was down. So anyways, what you've got here is that margin at a speculative peak in the stock market tends to top out a few months before the actual indexes top out. So we got that one. Then you have advanced decline lines, and they topped out in early June and have gone down. The ADs have deteriorated a lot, but then that's like the margin thing. It suggests a peak in the actual senior indexes a few months later. And so we've got a couple of these that, then you count it out, and it then comes back to, guess what, September. So I think this is falling into place nicely. And then you've got also the what's going on in the credit spreads, where you had enthusiasm for lower grade products going right into about May, and then the spreads narrowing, the spread being the difference between high grade bonds and low grade bonds, and then turning around. So the turn to widening since early June has been very similar to the turn to widening in 2008 and also in 2007 and also at the peak in 2000. Well, no, it's out of season with that one, but 1998 was the year that long-term capital management got into deep doo-doo and blew out and all that sort of stuff. So we have the change in credit spreads, even the breakout to new widening early July, and now we're waiting for later in July for the next jump up in widening spreads, and then that keeps us on track for things peaking in early September. So actually, this is really exciting for an old market historian like myself, and fascinating to watch it work out. And you've got the world's focus is on all these utterances by policymakers about what they're going to do about Greece and what they're going to do about the euro and what they're going to do, about Asia and all this sort of stuff. But if you just focus on Greece, they're, 1 week after the next, they're going to do this, they're going to do that, and the fix now is talked or decided, but I don't think it's actuated yet. And they'll find that the market forces will be faster than what they can do on policy making. So let's just look at the actual prices, credit spreads, this sort of thing, and the gold-silver ratio has been rising up to 76, and as we wrote yesterday, getting through 77 would be a real breakout. And when the gold-silver ratio goes up, it signals or is part of increasing concern in credit markets and liquidity and that sort of stuff. The interesting thing about the gold-silver ratio, it's been doing this for, we checked it back 400 years, where you have pretty good evidence of what's going on in the economy, whether it's expanding or contracting, and the gold-silver ratio has a tendency to act like a credit ratio, actually, or credit spread. And anyways, gold-silver ratio rising above 77 would be another signal that would be a negative for most everything out there. Commodities, crude oil, base metals have weakened. You had a very nice rally, a late rally out of the grains, a sharp rally there, and now that, of course, it was so fast that it's correcting in here. But On the longer term, we think that the grains are trying to build a base in here, the agricultural prices, and it could take a number of months to build the base. But other commodities, industrial commodities, they look awful. The weakening of base metals, and particularly the precious metals today, has driven the Toronto index down, and there's no getting around it. We still don't see the conditions needed to put in a proper big low or base or bottom for the precious metal sector. It's still bleak. We think that people should own a little gold as insurance, and working on a study now that the price of gold in different currencies, and so if you were in drachmas or in European currencies, the price has gone up. And of course, this is the whole point in insurance. Gold as insurance, it's there to protect you. And in the case of where you do have currency erosion, it's protecting you. So, but to try and make money out of positions in gold in U.S. or Canadian dollars, a bit difficult. So we would just stand aside on that. And again, on the stocks, we enjoyed a couple of the rallies in the year and used them to lighten up, and are just saying, neither long nor short in here. But one could consider that if the gold-silver ratio goes through 77, nimble traders could consider a modest position of being long gold and short silver. You're making money on the spread, but I think that maybe towards the end of the year, if there's some heavy liquidation in the fall, it'll present the next opportunity for looking at the long side of the precious metals.
We'll have more with Bob Hoye right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with market historian Bob Hoye. What's the story with crude oil?
A lot of it around. The whole game in crude oil was there was a huge premium on crude oil because of Middle East uncertainty. Plus, decades ago, you had the OPEC, which did have some power, and you also had the phenomenon of the story about peak oil. This was your sort of basic hand-wringing type of research that we're going to run out of oil. And I think in enthusiasm and also in the price of crude reached it. Peak oil peaked in 2008 when crude soared up to 147. It gave all kinds of upside exhaustion signals, so we concluded that not only was it going to be a cyclical bear for crude, but it would be a secular bear, and it continues. Now, even more recently, in the last few years, crude was hanging up there higher than it should be in the face of weakening other commodities, and then finally the realization of new technology in energy extraction with the fracking of natural gas and crude oil really came in, and the seasonals have changed. You used to be able to get a seasonal rally from around June. If you had a down dip in June, and then you get a rally out to around September, but that's changed now. So probably the seasonal high is in for crude oil, and probably the high for the year is in. And when last year in the first half, we were talking about the potential of crude oil going down, noted that historically in gold terms on the secular bear market for crude oil, it could fall to 25 of the high in gold terms. So there's a lot more down for crude oil, and there's nothing anybody can do about it. And that is a depressant for other commodities. Now, originally they went on about that the drop in gasoline prices would put more money in the consumer's pocket, actually take less out. But no, because the decline in crude oil and natural gas prices is indicating a weaker economy. So we've found that throughout history, rising prices are associated with good times and prosperity, and falling commodity prices are associated with contraction, recessions, and things like that. So falling gasoline prices and crude oil prices is not a good thing. So this isn't happy stuff for the weekend.
Bob, thank you very much for chatting with us.
Good to be with you, Jim.
My guest has been Bob Hoye. He's the Chief Investment Strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com Radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Comments or questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.